Please welcome Mark Woodworth, Senior Managing Director, CBRE Hotels Americas Research.
The sun goes down, the stars come down, and all that counts is here and now. My universe will never be the same. I'm glad.
That should work, hopefully good. So Dave, wherever you are out there, thanks again for the opportunity. There's a lot of familiar faces here. I'm curious, how many people have heard me speak before? Wow, that's kind of scary. I'm pleased that you decided to come back for another round of it and so forth. But so I've got 15 minutes that I want to share with you some of our current thinking. And it all evolves around the idea that times are good. And the question that we're getting most often from our clients nowadays is will they get better? And another real common question is, it's been good for so long, please tell us when the end is going to get here. It's got to be getting closer and closer. So for those of you that heard me speak before, by the way, am I in fact, how many of you view me as the highlight of the entire conference? It must be the light. No, I didn't see any hands go up, so I'll try to see if I can overcome that today. I thought this was a pretty cool picture. One of my colleagues, Jamie Lane, an economist with our firm, took this when he was over in Europe. And I thought it really captured the way we look at the marketplace today, that there's really bright horizons out there, and we mean that from a thinking about certain markets around the country and so forth. But there are some markets that it's really not clear. Times are not nearly as good, and we're somewhat concerned about what the near to midterm future holds. So this is what I want to cover in my brief remarks today. Hopefully I have time for a few questions when they're done. So my next question for you all, and I know that most of you are hotel people, especially I see Doug sitting out there, so Doug, to make it easy, I'm going to give you the 3 possible answers to this question, okay? So if you think back to last year about the economy, how many of you think that the economy last year in 2016 was good? Okay, about half looks like. How many was just sort of okay? Looks like almost the other half. Anybody think it was bad last year? Okay, so there's nobody from Houston here. Yes, no, okay. Oh, so you're a real optimist then, okay. Well, the reality is, and this is what we do for a living, it was not nearly as good as we had thought it was going to be. And what this chart represents here is as we moved towards 2016, and the first data point comes from the end of 2013, as we move closer and closer to 2016, the outlook continued to be downgraded. And in fact, reality last year ended up being a lot weaker than what we had thought. Anybody hear the GDP Q1 announcement this morning? Actually, that kind of thing excites me, so I was up early when it came out at 8:30. But it was 0.9, okay, which was not a surprise, but certainly not very good. Now, I didn't mean to bias your answer on this one, but how do you think the economy is going to be this year? Better than it was last year, pretty much the same, or worse? How many think better? How many think the same? Anybody think it'll be worse? Okay, that's quite a few of you. Well, again, the first quarter GDP number this morning, in fact, we did have time, it was 0.7. We did have time to update the slide here. It was a surprise, but we would point out in 2 of the last 3 first quarters, it was a something less than 1. So that first quarter has been weak for some time now. And if you notice the last couple of years, Q2, 3, and 4 were all significantly better than Q1 was. So the expectation is that in fact the rest of this year should be pretty good, and in fact the month of April seems to have started out nicely. And critically, if you look at those components of GDP change, business spending and investment and consumer spending, generally speaking, have been holding up fairly well, and the expectation for the rest of this year and next is that's really what's going to be driving economic growth here in the U.S. We do look at the index of leading economic indicators from the Conference Board very closely. The series that you see here, the red line is the historic lodging demand from STR. The green line is that index. You see that the two series, generally speaking, track together very, very closely. And if you look on the far right, and that most recent data point was the month of February, I believe that's the last one out, that you see that the trend line had been going down pretty consistently for the last couple of years, but it now seems to be bouncing back up a little bit. So that gives us some confidence and some optimism that, frankly, the good times that we've been experiencing for quite a while now in lodging should, in fact, persist going forward. Now, there's been a lot of concern in the industry about the amount of new supply that's been coming in across the country. Particularly, there's a handful of markets that have seen a lot of new rooms come in. And this year, if our forecast is correct, we think net supply change domestically will be about 2%, which is actually its long-run average. So on the surface, you would think, well, what's the big deal? If we look at some of the key gateway cities around the country, and we thought it might be interesting to say, over the last 5 years, 2011 was really the first point where it looked like the recovery from the Great Recession was beginning to firmly take hold and was going to persist, and in fact, it ended up doing so. So what we did is, for certain cities, and you see the ones here highlighted in green, that we just simply added up the annual percentage increase in average daily room rate, ADR, for each of the cities, and we compared it to the cumulative change in net available supply in each of those markets. And what you see in certain cities, in this case, LA, San Francisco, and Oahu, you effectively had no supply growth over that 5-year period. And not surprisingly, look at the level of rate growth we've had. So it was very much evolved into a seller's market in those communities, and their occupancies as of year end last year were very, very good. Conversely, we take that same set of cities and we look at some of the ones, Chicago, Miami, New York, and DC, but particularly New York City, you see that the level of supply growth over the last 5 years has been dramatic. New York has never seen that much new construction over that period of time in its history. And as a consequence, you can see that pricing power has been diminished very, very dramatically. So we think that's interesting. We reached out to get ready for today. We reached out to our friends at TravelClick. I suspect that a lot of you are very familiar and use their data. And they provided some information that I wanted to share with you today. This happens to be our data. In talking with Dave and getting ready for the conference, we wanted to share some insights as to where we thought the buyer markets were going to be going forward and where the seller markets were going to be. We do prepare forecasts on a quarterly basis for 60 of the largest domestic hotel markets here in the U.S. And these markets that you see listed right here, and I starred the ones that are the bigger markets, the top 10, that represents our estimate of how their prices are likely to change on average this year and next. So these are some of the softest, weakest markets. The vast majority have been experiencing some meaningful levels of supply growth. Others have had that plus some economic challenges. So you can see that pricing, the national average rate of increase, we think this year and next is going to be 3%. These are well below that number, so we view those again as good pace to be buying this year and next. Conversely, on the other end of the scale, you see the markets here that we think are positioned to have the strongest price increases this year and next. And interesting enough, my hometown, Atlanta, it continues to just really perform in a very strong way, much better than I've seen in the 35 plus years of doing that. So here's the TravelClick data. What they shared with us for this meeting right here is on 10 North American markets. Those are the cities that are listed. It's about 29,000 rooms, and it covers the advanced view starting the quarter we're in now through the first quarter of 2018. And data is the first of the month. Katie, if you don't get their data already, Katie is the one who shared that with me. By the way, I'm happy to make the deck available. Anybody that would like it, just see me afterwards and give me a card and we'll send it to you. I guess I meant to say this right. You shouldn't start a presentation like this, but I got to tell you, I don't think I have a lot of exciting things to share with you today. I'm sorry, I try to do that. I think part of my job is to make people happy and smile and so forth, but it's a little challenging right now because, times are good and they're not going to get a whole lot better and they're not going to get a whole lot worse. So depending upon where you sit, that's either kind of a happy view or, geez, I like it when things are a little more volatile and that's where opportunities may lie and so forth. So what we're seeing here from the TravelClick data, and again, this is focused on the luxury segment. Occupancy is up a little bit, but recently the pace has been down. So that's arguably not necessarily good news on that front. From a group perspective, year over year, it's down a couple of points. In the recent pace is down somewhat. On the transient side of business, bookings are up considerably for the next 4 quarters. But again, the recent activity has been relatively flat, so the pace seems to be slowing down a little bit. You see the business side has been down, but the leisure side, according to TravelClick, is up significantly for the next 12 months. So it'd be interesting, maybe over the cocktails tonight, I'd love to hear what's happening in your neck of the woods on that. Again, from a pricing perspective, what was inflation last year, by the way, in the United States? Anybody know? It was almost zero. It was almost zero. So when we look at a 1.2% increase, most of that is real growth, which from a pure economic perspective is a good thing, but overall far short of what we're used to. And we don't see a lot of optimism in the data, a little bit on the transient side. But again, if you look at the leisure piece of the transient component, it's the volume is up, but the business is down. The outlook over the coming year, from a market level perspective, here's the cities that right now occupancies are up year over year. Conversely, the balance of them shown right here are on the downside. San Francisco, interesting for being strong for so long, as many of you may know, is having a weak year and probably have another one in 2018. The pace is down in just about all markets except the 3 that are listed right there. Price increases are likely to be most robust, so therefore if you're on the buy side, a little more challenging in the 5 cities that we show there. And from prices actually going down, it looks like we're seeing a little bit of contraction in those particular markets. There's the data on the group outlook. Slight increase in Atlanta, Boston, LA, and Phoenix. Dwarfed, however, by the weak pricing power that we're seeing in the balance of these particular markets. Here's our forecast. Of the 60 cities, again, that we track very, very closely, occupancy levels we think are going to go down in 51 of them. So not to be alarming, because one of the reasons that occupancy is going down in some of these markets, it's a combination of supply growth is picking up, but also that price increases in some of these markets have been so strong that demand is reacting a little bit negatively to that stronger price growth. That's for this year. We look at that 2% as the long run, really inflation number now. So we see prices going up in excess of 2% in the vast majority of the markets. We think overall that's a good thing, healthy thing for our industry. Here's our forecast. If you somehow remembered what I showed you in, I guess we were at David's place down at Doral, I think the last Allied, this meeting. The numbers really haven't changed that much. One of the areas that we've been frankly consistently wrong on is prices are not increasing as quickly as we thought they would be. So we continue to downgrade our average daily rate growth. But overall, if you look at the numbers benchmarked against long run average, where we're headed this year and we think next, still pretty good. If we look specifically at the luxury component of the hotel industry, we are seeing greater levels of new construction in the supply side, so that's is hurting pricing power in some key markets around the country. So you see the RevPAR outlook is a little bit weaker for the high-end properties. So I don't want to just stand here and read these to you. Here's some summary thoughts, and if we have time for maybe a question, I'd like to try and do that before I turn it over to Michael. Yes, sir. Oh, yeah. Yeah, okay, for those of you that might not have heard the whole question, the question is basically, has the industry fully recovered? It's a kind of question that I, as a consultant, love to answer, because it starts with, it depends. Right? It depends. Are you talking about revenue, or let's say RevPAR and so forth? In real terms, it's fully recovered about 2 years ago. Total revenue per available room, like I say, last year I think it was, came back. From a bottom line perspective, I think 2016 is we're just now getting back to the peak level of historic profitability. And a lot of the challenge has been, as you saw, a lot of those markets have seen some pretty strong revenue growth since 2011. But as you say, some of the costs have been going up dramatically, starting with the labor component. So, yeah. Yes, ma'am.
I'm in Honolulu and really see the impact of Airbnb and VRBO on our occupancies in hotels across Waikiki. Are you seeing that in other cities as well?
Okay, so the question is that Airbnb is impacting occupancies in Waikiki. I think that's a myth.
Really?
I just want to see what your reaction would be. I don't really know. That's what see, I was standing over here behind the couch.
800 more units at the end.
Well, yeah, I think if I want to take you literally for a moment, because we watch Airbnb very closely because we think it's important that we're all aware of what's going on in that space. There has been significant Airbnb growth in Hawaii and in Waikiki, Honolulu specific. A lot of that seems to be that units that were being marketed through other channels. I mean, as you know, in Hawaii, it's been a practice for a long time of this kind of renting. So a lot of Airbnb specific growth has come from people now adding them as a new channel, as opposed to somebody saying, I now have a unit that I'm going to put into inventory that wasn't there before. And in fact, some of you may have seen about a month or so ago, we released a big study that we did for AHLA on multi-unit hosts with Airbnb. And by far the biggest growth over the past 12 months has been resort destination. What do you? Well, but what are the rental? I'm just trying to rental companies. Then again, most resort they've had them forever, and again, that's it. I'll track me down to the cocktail party. I'll remember by then. Yeah, vacation rental companies and so forth. Yeah, now again, they're just finding that Airbnb is a very well-known and efficient channel to put their inventory in. But we are watching it closely, as we think everybody should be. Yeah. I'm really kind of tired of hearing myself talk, and I'd like to go hear my friend come up. So, thanks for your attention.